All right, so we'll do chapter 19 tonight, pensions and other post-employment benefits. So it's a little bit easier than the chapter you did last week, so yay. So doesn't work. All right. A pension plan is an arrangement in which an employer provides benefits to employees after they retire for services that they provided while they were working. There's two types of pension plan. There's the defined contribution plan. So that specifies how the employer's contribution or payments into the plan are determined, rather than identifying what the employee will receive at the end when they retire. And there's a defined benefit plan that specifies either the benefits that are going to be received by the employees when they retire. So for the defined contribution plan, basically, it means that the employer's contribution are defined and the employee's benefits aren't. So that means that, for example, every pay, the employer puts 2% of the employee's salaries into a trust. So the employers know that each pay, they're going to put in 2% of the employee's salary. But they don't know at the end how much that's going to be, like how much the employee is going to get from this contribution plan. So some example is that they put $5,000 per year into trust, or 6% of regular plus overtime earnings for the years. So there's no promises about what the employee is going to get at the end. So the risk is to the employee. What it means by the risk is to the employee is that most of the time, the contributions that the employer does are put into a trust, and that trust is going to administer the employee's plan. So they're probably going to invest it in equity instruments. So that means that the return on these equity instruments can be lower or higher than what was initially put in. So let's say it's all put into shares of Tesla, which I mean shouldn't be a good idea, but all the employees' contribution are in Tesla shares. Hopefully, Tesla shares are going to go up by the time that the employees retire, but they might also go down. If they go down, the employer doesn't have to do anything. They already put in 2% of the salary, so they're like, well, sad for you. You're going to have to figure out what you're going to do for your retirement. So if they go up, good for the employee, I guess. They got more than expected. And the trust, what I mentioned earlier, is separate and distinct from the employer. So it's not this, it's a third party. It's not the employer that's taking care of the contributions. They only put in money into that trust, and then the trust administers the funds. The employer accounting for defined contribution plan is pretty easy. Basically, you're going to record a liability when they didn't pay their contribution on time, or it wasn't the complete amount. And they're going to record an asset if they contributed more than they needed to. And then here, if you have past service costs, it's immediately an expense. Interest, if you have accrued contribution required to be made in future periods, it's going to be recognized. And an unallocated plan surplus is going to be recognized if there's any interest earned on the unallocated plan surplus. So this is the defined contribution plan. You're not going to be asked to do any entries on this, just for your general knowledge when you go into the workforce, because it's the most popular plan because the employer doesn't have any risk. So the accounting, you're not going to get asked really a lot of questions on that, and maybe theory questions, but I would be really surprised. Then there's the defined benefit plan, which the accounting is a bit trickier because there's a lot of estimates done by actuaries and that goes into it. So a defined benefit plan is that the employee's benefits are defined and the employer's contribution aren't fixed. So what that means is instead of the employer contributing 2% per pay per salary, they say, okay, well, when you're going to retire, we're going to give you $10,000 per year. So at the end of the day, the employee, when they retire, they need to get $10,000 per year. There's also the whole vesting versus non-vesting. So vesting means that an employee keeps the rights to the benefit, even if the employee no longer works for the company. So if an employee whose benefits have vested leaves the company, they're still going to receive the benefits that they accrued while they were working. And if they're not vested when the employee leaves, the employee loses the rights to the benefits. So the objective when accounting for a defined benefit plan is that the expense and liability amounts related to these plans are recognized over the accounting periods where the employee is working. So if I'm working for 20 years in a company, I have a defined benefit plan where I earn $10,000 per year until I die, let's say. Well, that $10,000 per year until I die, we want to recognize it in our books while I'm working. So there's a lot of, uncertainties that goes into it. So the longer you work for a company, the bigger your benefit is going to be. So the company has to make sure that they're going to have enough money or cash or resources to pay the benefits at retirement for the employee. So usually there's a requirement that funds are set aside during the service life of the employee. So while the employee is working, the company is going to be setting aside money to pay them in the future. The difference in accounting under ASPE and IFRS is that there will be measurements done by actuaries. Under ASPE are charged to net income, so they're expense, whereas under IFRS, they're charged to other comprehensive income. That's the only difference between the two. So anytime there's an actuarial remeasurement. So for the defined benefit plan, the beneficiary is the employer. The other plan was the beneficiary was the employee. The trust, so there's still a trust. So the employee still puts money into a trust that administers the plan. And their main purpose is to safeguard the assets and invest them so that there will be enough to pay the employer's obligation to the employees. So they have to make sure that their return on the investment that they do with the contributions are enough to pay in the future whatever amount the employee is entitled to. So the trust is a separate entity, but the assets and liabilities of the trust belong to the employer. So as long as the plan continues, the employer is responsible for paying the defined benefits, no matter what happens in the trust. So let's say that all your assets in the trust are investments, and there's a financial crash on the market, and the value of the assets goes down a lot, and you still have to pay the benefit that was promised to your employee. So you're going to have to figure out how you're going to pay whatever amount the employees are entitled to under the defined benefit plan. So the employer assumes the risk, and they must make up any shortfall in the accumulated assets held by the trust. There's two parts in a defined benefit plan. There's the accrued benefit obligation and the plan assets. Accrued benefit obligation is the ABO, and I think it's also referred as DBO, defined benefit obligation. It's the employer's obligation to pay out benefits in the future for the employee's services up to the date of the statement of financial position. Most of the time it's estimated by actuaries because there's a lot of things that could happen that accountants don't know how to calculate. And the plan assets, it's the setting aside plan assets to fund this obligation. So the cash that you're going to set aside to pay in the future, or investments, or sometimes also maybe you buy buildings and stuff like that. So any asset that you purposely held to fund the defined benefit plan obligation. So we're going to see how to calculate these two. So to calculate the accrued benefit obligation, you start with your balance in the beginning. You add your current service. We're going to go over all of these in a minute. So you add your current service costs, your past service costs, your interest costs. You deduct your actual gain on ABO, or you add your actual loss on ABO, and you remove your benefits paid to get to your ABO ending. So current service costs are the cost of the benefits that are to be provided in the future in exchange for the services that the employees provided in the current period. Just a broad definition. You're not going to be asked to say like, oh, word for word what it is. So most of the time that's going to be, well, all of the time that's going to be given in the problems because it's calculated by actuaries, and it's expense under ASPE and IFRS. Then you have the past service cost. It's when a defined benefit plan is started or amended. A credit is given to the employees for the years of services that they provided before the date of the start of the defined benefit plan. So what the actuary is going to do is they're going to remeasure the DPO, and most of the time it's going to end up being larger than what it was before. So whatever the amount that was larger by is the past service cost. So most of the time it's going to be given. They like to put that little trick in to find the past service cost by using this formula, which is normally used to find your net interest cost. So you can find also your past service cost by dividing your net interest cost by the percentage, your market rate, minus your beginning ABO. Your past service costs are expense under ASPE and IFRS. So interest costs is the interest that accrues on the DPO, just as it does on any discounted debt. So the interest is based on the DPO that is outstanding during the period, taking into account any material changes in its balance during that period. Your interest rate is always going to be equal to current market rate when you're doing this type of problems. And how to find the interest cost is you take your current market rate times your beginning DPO plus your past service cost. And it's expense under ASPE and IFRS. Your actual gain or loss on ABO, it's a change in the actuarial assumptions. So they're either going to say that you're going to be paying more or less in the future in relation with your ABO. Usually it's given, and it's expense under ASPE, and it goes in the other comprehensive income under IFRS. Your benefits paid to retirees, it's when you're making the payments of the pension benefits to the former employees, and it reduces the plan asset balance under ASPE and IFRS. So we're going to see it a little bit later. So your plan assets, how you calculate it, you have your plan assets at the beginning, your expected return on assets, your employee contribution reduced by your actual loss, or increased by your actual gain on investment minus your benefits paid. Then you get your plan assets ending. So what are plan assets? They're the assets that have been set aside in a trust or other legal entity that is separate from the employer company. The assets are restricted, so they can only be used to pay the benefits to the former employees. So it's made up mainly of cash and investment in debt and equity securities. Your expected return on assets. What's the difference between actuarial reevaluation and actual return? So your actual loss, gain on investment, and this here, gain loss on ABO. So basically your actual return on ABO is what the actuaries have calculated for your ABO. And your actual return is what you're actually going to get back during the year. So they do an assumption. They think, oh, I'm going to earn $10,000, but actually you're actually going to gain during the year on your asset. You're going to gain $5,000. So you've got a loss of $5,000. So the actual evaluation was higher than what it was actually. Was that clear? I think I mixed up my words, but your expected return on assets. Yeah. Do you want me to go over it again? Because I think I'm not sure about actual reevaluation if you're talking about investment or ABO. don't think I get the difference. Okay. So the actual return on ABO. So what the actuaries do, they're going to predict in the future how much you're going to have to spend in your ABO and how much you're going to have to set aside in your plan assets to pay for your future ABO. So the actual actuarial reevaluation for your ABO, they do their little calculation for the year. And for the year, not for a year, in total, in the future, in comparison to last year, well, your evaluation for the ABO is either going to increase or decrease based on the new current information that they have. So let's say your ABO balance in 2017 was $5 million. And then for whatever reason, what happened during the year, now they think that the ABO that you're going to have to pay in the future is going to be $6 million. So your ABO increased by $1 million, and that's going to be in your actuarial loss on ABO. So that's going to touch your ABO account. So that's what we saw earlier. The actual actuarial loss or gain on investment, that concerns the assets that are set aside to pay your ABO in the future. So your actuaries, again, they're going to calculate, okay, well, I think that because of the investments, they're going to go like this or that during the future year. I think that my investments are going to give me a return of $1 million in the future. But so in comparison to your previous year's balance, you're going to be, if it's higher, you're going to record a loss. If it's lower, you're going to record a gain. So if they have to reevaluate the investment that they're making. And then your expected return on asset is during the year, how much is expected that they're going to earn on their assets. So normally, let's say that it's 8% of their current market rate is 8%. So they're expecting that they're going to earn 8% of return on their asset during the year for the assets that they have at January 1st. But then your actual return is that instead of having 8%, they're going to get 3%. It was lower than expected. So that's going to be your expected return on asset is going to be lower. And you're going to put what your actual return is going to be a loss. Basically, it's going to come and reduce your expected return to get the actual return. I hope that was clear. You're going to see while we do problems. I think that's more clear. Okay. You don't need to really know the definition. I'm going over it just for personal knowledge, but while you're doing the problems, they're not really going to ask you, like, can you write me the definition of the actual return? I'm just going over it so you know, but it shouldn't be a problem while you're doing problems. All right, so expected return, like I mentioned, it's the difference between, your expected return on assets is the income generated on the assets being held by the trustee, less the cost of administering the fund. So that's what you think that you're going to get as a return on the assets. Again, your interest rate is going to be equal to the current market rate. And you calculate it using your current market rate times the beginning plan assets. And it's a benefit, so you credit your expense under ASPE and IFRS. Then you have the employer and employee contribution. Usually it's given. And then for the employer contribution, you credit cash because they're paying the cash. And for the employee contribution, you credit your expense under ASPE and IFRS. Your actuarial loss on investment, so it's the difference between what has actually occurred and the previous actuarial assumptions about what would occur. So if your expected is smaller than the actual, it's a loss. And if the expected is greater than the actual, it's a gain. It's expense under ASPE, and it goes in other comprehensive income under IFRS. So that's how you calculate plan assets. Then you're going to have another account that's called net benefits asset or liability. And that basically is the difference between the ABO and the plan assets. So the difference between the two is either going to create a surplus or a deficit. So if the ABO is underfunded, your ABO is going to be greater than the plan assets. So that's going to create a deficit. So you're going to record a liability. And if it's overfunded, your ABO is smaller than your plan assets. That creates a surplus, so it's an asset. So all of that to say, this is the most important slide of all. Basically, that's how we calculate our balances for the ABO, the plan assets. That's how we calculate the expense, the OCI, if it's under IFRS, and everything. So how this works, normally you're going to get in the problem a bunch of facts about the company's defined plan. And what you're going to do, you're going to fill in the blank. So most of the accounts here are going to be given to you. Where they might try and trick you is the underfunded, overfunded part. So you have to know what's happening when it's overfunded versus underfunded, because this is going to affect your net benefits asset liability. You also need to know your net interest cost formula and know that your past service costs can be calculated using this formula. And then your expected return on assets and your actual loss on investments. So that's basically all that they can trick you with, because that's the only formulas that accountants are going to use to compute stuff. The rest should be given, and you just plug them where there's the little stars. When I put the table here is debit, so every account here, think about it as a debit. That's why here your obligation is all negative, because your obligation is a liability. You need to pay money in the future. So when it's negative, it increases it. When it's so negative, it's a credit. When it doesn't have the little parentheses, it reduces it, so it's a debit. And then from there, you're going to be able to record your journal entries. So you have normally 2 journal entries to do, your expense entry and your funding entry. Your expense entry, the amount you're going to record your expense under ASPE. And if it's under IFRS, you're going to record your expense and also your OCI. And then whatever amount, these 2 go together and it goes in your net benefits liability. And your funding entry is the amount that the employer paid in contribution for the year. And it also goes in your net benefit asset liability. And then with that, you get your balances at the end of the year for these 3 accounts. You don't have to record an entry for those. So I put here a type of journal entry that you can use. So we'll jump into the problem. I don't have an Excel sheet open. Hold on, my computer is being slow. All right. Okay. So I highly recommend that I don't remember if my final exam wasn't proctored. I don't think yours is either. So for this question, I recommend you to prepare like a table like this, where your formulas are already put in. So you just have to put in where there's colors here. I can post it on the Facebook group when I'm done. So you're just gonna have to fill in the blanks. Here in the green, it's ASPE and IFRS. In the blue, it's ASPE, and in the yellow, it's IFRS. So with that, I'll start with problem 1. You are elated to have landed the summer job of your dreams as an accountant intern with Hire and Fire Corporation, a national executive recruitment firm. Your supervisor and mentor, Ria Tears, greets you with a tough assignment on your first day of work. She handed over a sheet containing some hastily scribbled notes and a comment. I wish to start you off with something light and easy. Here are some notes on our pension fund's operations for 2017. Could you please sort this out by the end of the day? And yes, did I tell you our firm is currently with ASPE, but considering a switch to IFRS in 2021. So ASPE, so everything's going to be expense. The note contained the following information. Beginning projected benefit obligation, BPO, is $5,068. I didn't say $568,000. The plan is underfunded by 60% of this amount, and the regulatory agencies consider this to be quite heavily underfunded. Prior service costs were recorded on January 1st, 2017, to be determined by the intern. The current service cost for 2017 amounted to $140,000. The plan uses an interest rate of 8%. We recorded an interest expense of $52,240 for 2017. Our investments of the plan assets did very poorly, earning only $13,178 on our plan assets in 2017. So that's the actual return of the plan assets. The corporate pension committee overseeing the plan operations had decided to fund an amount of $35,000 in addition to our normal annual contribution, which we make as per our corporate policies. The corporate normally contributes 5% of the PPO carryout forward from 2016, plus 50% of the current service costs and 60% of any past service costs occurred during the year. Employees funded $20,000 to the plan as it contributory pension plan. Benefits payments for the year $74,000. It was determined by the firm's actuaries that the ending balance of the plan assets appropriately reflected their firm market values. And the projected benefit obligation was re-evaluated at the end of the year and should reflect a $50,000 reduction in the BPO otherwise determined. A little while later, while you were sorting things out, she arrives at your solid oak wood desk and gave you some more specific instructions. Give me a summary of the activities, showing them on a worksheet for ASCII. So we're going to do that first. So a lot of information here, but just take one bullet point at a time. For my final, it was online too. And I had one of the big questions I had was this. And it was basically fill in the blank. And then they were asking us in the multiple choice question, like, what's the current service cost? What's the first service cost? Stuff like that. So when you're solving, take it one bullet point at a time, and you're going to be fine. So first, what they're telling us is that BPO is the same as ABO, by the way. It's just that under IFS and ASCII, they're named differently, but it's the same thing. So the beginning projected benefit obligation is $568,000. I'm going to put that as a negative because the balance of the ABO is a negative. It's a credit balance. And then it says here that the plan is underfunded by 60% of this amount. So when it's underfunded, remember from the PowerPoint, when it's underfunded, it means that your ABO is greater than the plan assets. So it's greater than the plan assets by 60%. So it means that your plan assets are 40% of this amount. And I'm going to put it as a debit, as a positive, because plan assets increase as a debit. And then the difference between the two is going to be a liability. So this should be 60% of this. So let's just calculate it. And we're good. So I put it here because your ABO is greater than their plan assets because it's underfunded. Okay, so we're done with the first bullet point. We're going to go to the second part. Since that the prior service costs were recorded on January 1st, 2017, we're going to have to determine them. So we're going to need our net interest costs to be able to figure out our past service costs. And the current service costs for 2017 amounted to $140,000. So I'm just going to put that in our current service costs. The plan uses an interest rate of 8%. We recorded an interest expense of $52,240. So we have the amount here. So with this amount, we're going to be able to figure out the past service costs. So we do that by basically isolating our past service costs in this formula. So it's going to be the $52,240 divided by our interest rate of 8%, minus or beginning ABO minus 568,000. It's going to give us 85,000. Yeah, so that's it for point 3 and point 2. Our investments of the plan assets did very poorly, earning only $13,178 on our plan assets in 2017. So we have the actual return here. So it's going to be for sure 13,178. But now we have to find our expected return on assets to be able to figure out the actual loss. So to figure that out, you use again the same interest rate, the 8%, times your beginning balance of your plan assets, so times the 227,000. And this is going to be as a negative, it's a credit. Then to figure out your actuarial loss, you're going to do your 18,000. The interest cost isn't here. No, your net interest cost isn't just your 8% times ABO because you have past service costs that are taken into consideration. So when there's past service costs, they're going to mention it to you in the question. You want to add it to your ABO to find your interest cost. Yeah, so if that wasn't given, you would have your past service cost that was given. So you would have had the $85,000 and you would have had your $500,000. So you would have done your 568,000 plus 85. Okay, if they don't mention in a problem that there's service costs, then you only do times your ABO to find your interest cost. It's only if they mention that there's past service costs that you add it to calculate your net interest cost. Because here in your calculation, your past service cost would be 0. It depends. There's not always past service costs. It depends if they had employees before and they do the whole amendment thing. So if they don't mention past service costs and you need to find your interest costs, you just put 0 and you just do your 8% times ABO. No problem. All right, so to find your actuarial loss, you do your 18,000 minus your 13,000, and that gives us an actuarial loss of 4,998, and that reduces your plan asset by the same amount. So you see, if I add them together, your return completely is equal to your actual return of 13,000. So that's what you want to look for. Then their corporate pension committee overseeing the plan operations had decided to fund an amount of $35,000 in addition to our normal annual contribution, which we make as per corporate policy. So the cash contribution, that should be here. It's $35,000 for sure. And all of this as a negative because you're paying cash. And then it says that normally it contributes 5% of the PBO. So 5% of 568,000 plus 50% of the current service costs. So 50% of 140,000 plus 60% of any past service costs incurred during the year. So 60% of or $85,000 here. So that gives us a payment of 184,000. I'm just going to update this here. And that increases our plan asset. Then the employees funded $20,000 to the plan as its contributory pension plan, so that they paid $20,000, so that reduces our expense by $20,000 and increases our plan asset by the same amount. Benefits payments for the year were $74,000. So that reduces both the ABO and the plan assets because you're doing your payments. And then it was determined by the firm's actuaries that the ending balance of the plan assets appropriately reflect their fair market value, so that you're good. You don't have to make any adjustments. And the projected benefit obligation was reevaluated at the end of the year and should reflect a $50,000 reduction in the BPA or otherwise determined. So that means that here we have the balance here without the reevaluation. This needs to be $50,000 lower because that's what the actuaries say they need to put it down by. So we're going to reduce it by $50,000, and that's going to create an expense of, no, that's going to create a loss of $50,000. Wait. I mixed up my signs here. It's $50,000 as a debit, as a positive, because you want to increase it. Anyways, I think you got it. So now we've done all the points. We've done the worksheet. So they're going to ask us to prepare the journal entries. This is under ASPE. So first we're going to have our expense entry. So it's pension expense for this amount, the 194. Yeah, so because we're debiting it, because your obligation is a liability, so you want to debit it instead of crediting it, because you're debiting, so you're reducing the balance of what you're going to pay in the future. Here, your ABO, yeah, no problem. And then your credit to the pension expense is this account here, your net benefits asset liabilities for the same amount. And then your funding entry is, again, the same account here, your net benefits asset liability, and it's the 184,000. And you credit your cash because that's the payment that the company made during the year. And that's it for ASPE. Then they're going to ask us under IFRS, what would have been different? What would have been the amount of the expense? So what you can do here, you can start with your pension expense under ASPE. That was 194,000. And then the two accounts that are affected are your actuarial loss and your the two actuarial losses. So you want to cancel the effects of these two in your benefit expense because they're going to go in your other comprehensive income under IFRS. So your actuarial loss on ABO, sorry, I have a difficulty saying that word. Here it was debit, so you increase your expense, so you want to reduce it. And then your actuarial loss, oops, no, sorry, on ABO, this is ABO, this is investment. This is ABO, so investment, your 4,000 here. And then loss on ABO was, it reduce your expense by 50,000, so we want to add it back. So plus $50,000. And that's going to give us our pension expense under IFRS. So it's going to be yeah, $234,000. So that's it for question 1. And then for question 2, I'm going to copy again the same thing here. For question 2, in late 2000, Bunky Waves Limited established a defined benefit pension plan for its employees. At the inception of the plan, it was decided that both the interest expense accruing on the DBO and the expected returns on the plan asset will be computed only on the balances existing at the beginning of the year. Further, such balances would be adjusted for any changes affected by transactions occurring at the beginning of the year. For the year 2015, the following information was provided to you by a trainee accountant of the company. So I'm going to do it as we go through this, like the pension worksheet. So Wonky Ways followed IFRS procedures and ended its accounting year on December 31st. So we're going to use the OCI now column because they're using IFRS. The discount rate as well as the expected rate of return on plan asset was 5% per year. So we're going to use 5% to calculate our net interest cost and our expected return on assets. The accountant did not remember the beginning balance of either the DBO or the plan assets. Oh, he was so disorganized. Great. Fortunately, he did recall that the interest expense for the years was $136,500. That's what I'm going to put here. He also complained that the investment committee was, in his opinion, not doing a good job at the actual returns amounted to only $57,330, which resulted in an annual return of a poor 3.5% rate of return. So what that means here, your actual return on your plan asset was $57,000, which is equal to 3.5% of your beginning balance of your plan asset. Your expected return is 5%, right, of your plan asset. So with this information here, we're going to be able to find our beginning balance of the plan asset, and then we're going to be able to calculate our expected return on assets. So to find the beginning balance of our plan assets, we're going to do our actual return divided by the actual percentage return. So it's our $57,330 divided by 3.5%. Just making sure. Yeah. So our plan asset is beginning balance is $1.6 million. And then our expected return on asset, we're going to be able to find it by doing 5%. So what we use to calculate our expected rate of return times the beginning balance of the plan assets. So that gives us in the negative $81,900. He then proceeded to read out a bunch of figures, $201,000 for current service costs. And then $60,000 for past service costs. So here, it was given to us the interest expense for the year, but if it wasn't given, it says here that that both the interest expense and the expected returns on the plan assets will be computed only on the balances existing at the beginning of the year. So here what it says is, if the interest cost wasn't given, but the past service cost was given, to calculate your interest cost, you would only use the plan asset because it only takes into consideration your beginning balance of the year. It's not taking into consideration your past service cost. So could be, you have to be careful when reading. Yeah. All right, so yeah, $60,000 for past service costs awarded at the end of the year to a new executive, $312 paid to existing retirees. So that means that your benefits paid was $312. And $240,000 received from the company as the annual funding for the plan. So they contributed cash, $240,000. Upon quizzing him further, you also learned that the funding statutes at the beginning of the year reported an underfunding. The plan assets were 60% of the defined benefit obligations. So this here is 60% of here. So to find it, you're going to divide it by 60%. And then it's underfunded. So that means that here it's going to be a liability of $1,092,000. In each alternate year, every odd year following inception of the plan. So it's an odd year. So we're going to have to do that, whatever they tell us. The actuary remeasured the definite benefit obligation arising from employee services and recommended that the plan amend its accounting figures accordingly. The actuary would also revise estimate parameters based upon his latest estimates. For the 2-year period ended in 2015, the revised estimate for the DBO amounted to $2,955,000. So what that means is here, your balance at December 31st needs to be $2,955,000. So to do that, we're going to have to increase it by your $2,955,000 minus your balance here. So $2,085,000. Oops, no. It's not the right amount. I'm going to calculate it separately just in case. Yeah, so you have to increase your DBO by this amount, the 100,039,500. I'm so sorry about my words. Can't say the numbers today. And so this, since it is under IFRS, you're going to have to record your loss here. And then I see here that I forgot to calculate my actual loss on investment. So I do have the expected return, which was 81,900, and they did give us the actual return, which was 57,330. So here should be this amount. So if I put them net together, the actual return that increased the plan assets was the $57,000. All right, so that's it for the worksheet. So then we're going to prepare the journal entries. So the pension expense, the pension entry, well, the expense entry. So you're going to have your pension expense of $315,000. You're also going to have your other comprehensive income because you're under IFRS. So this is going to be your $164,000. And then the same account as earlier, your net benefits asset liability. It's going to be the sum of the two. Here, I forgot to add my OCI. Then your pension entry, your funding entry is your net benefits asset liability, credit cash for $240,000. All right, and then they're going to ask you what would be the amount of pension expense the company would record if it were following ASPE instead of IFRS. So you want to add your two actuarial losses to the expense. So we're going to start with the pension expense under IFRS, which was your 315 here. Then you have your actuarial loss on investments, which is F2021. Then you have your actuarial loss on ABO, which is the $139,000. That gives us our pension expense for ASPE of $479,000. And that's it. So you see that it's an easier, wait, I'm going to stop the